So, if you've been keeping an eye on the markets, you've probably seen silver take an absolute nosedive. And it's confusing, right? It's supposed to be a safe haven. So, what's going on? Well, in this explainer, we're going to pull back the curtain on the mechanics behind that crash, and you might be surprised by what we find. Okay, let's get into it. First things first, let's just bust a big myth right from the start. This huge price drop, it wasn't some crisis of faith. It wasn't because everyone woke up one morning and suddenly decided silver was worthless. Nope, the real story is way more interesting than that. And look, it also didn't crash because its role in the real world just vanished. I mean, it's still absolutely critical for everything from solar panels to high-tech electronics and medical gear. That real-world demand didn't just go poof. The truth is, the crash was less of an accident and more of a consequence. It was driven by some really powerful forces in the market that had a problem, and silver just happened to be the perfect and necessary solution. So that brings us right to our first big question. Was this crash engineered? We're going to have to dig a little deeper than the headlines and start questioning that official narrative. And this is really the core of the whole mystery. I mean, think about it. It seems completely backwards, doesn't it? The exact moment you'd think a safe haven asset would be soaring, when fear is through the roof and you can hear the central bank money printers warming up, it gets hammered. Trust me, this pattern is not a coincidence. To really understand this pattern, we have to talk about how silver's price is actually set. And that brings us to something called the paper-silver illusion. This is where you kind of have to rewire your brain about what silver is. We think of it as a lump of metal, right? But in the world of high finance, it's often used more like a financial weapon. The price you see on the screen isn't being set by a guy buying a few coins. It's being set in the wild, high-speed world of paper contracts. It's really a tale of two silvers. You've got the physical stuff. You know, the limited supply, the metal we need for industry, the stuff people hold on to for the long term. And then you have the paper market. This is a totally different universe of massive leverage, futures, options, all traded for short-term cash needs. And here's the key. That paper market is what dictates the price. And just to give you an idea of how lopsided this is, for every single ounce of actual physical silver that exists in a vault somewhere, there can be dozens, sometimes hundreds, of paper claims, or IOUs, trading on top of it. This means the paper market has almost complete control over the day-to-day price. Okay, so if the paper market is the one driving the bus, what caused it to drive right off a cliff? Well, that leads us to the real engine behind the crash. It was a forced sale. Here's the play-by-play. When the whole market starts to panic, big funds start bleeding money in their stock and bond portfolios. Their lenders get spooked and hit them with margin calls, basically saying, you need to cough up more cash right now. So these funds are in a desperate scramble for cash. What do they sell? They sell what they can sell the fastest, and that means liquid assets like gold, crypto, and, you guessed it, silver. And this is the most important thing to get. Silver doesn't crash in these moments because it's a weak asset. It crashes because it's a great asset for getting cash in a hurry. You can think of it as the financial system's emergency ATM. Its biggest strength, its liquidity, becomes its biggest weakness in a short-term panic. But while all this chaos and panic selling is going on, there's another group of people watching, and they see something completely different. This is where we get into the smart money playbook. This really shows you the two different mindsets. The average person looks at the screen, sees the price plummeting, and feels that gut punch of fear. They see weakness. But the smart money, the big institutions, the really savvy investors, they're looking right through the noise. They don't see weakness, they see a forced sale on the paper markets. They see margin calls. And what does that all add up to? A temporary discount on a real hard asset. Because let's be real, underneath all the paper shuffling, the fundamental truth of silver doesn't change one bit. We still need it for solar panels. We still need it for all of our electronics. We still need it for medicine. And there's only so much of it on this planet. That's the intrinsic value that smart money never loses sight of. Now, here's the final piece of the puzzle. This whole chain reaction, it's not a one-time fluke. It's actually a predictable, recurring cycle. And once you see it, you can't unsee it. It almost always plays out in these four phases. First, central banks jack up interest rates to fight inflation. That makes holding cash look pretty good. Then, phase two. Those high rates eventually break something. The system cracks, a crisis hits, and everyone scrambles for cash. That's the crash we've been talking about. Which leads to phase three.
To stop a total meltdown, the central banks have to flip and turn on the money printers. And finally, phase 4. All that newly printed money has to go somewhere. It chases scarce things like physical silver. And that's when you often see prices explode to the upside.
So if you only take one thing away from all of this, let it be this. Silver didn't crash because it lost its value. It crashed because the financial system was gasping for air and desperately needed liquidity. Its price fell because of its utility, not its weakness.
And that really leads to this final powerful idea. For the people who understand this cycle, a scary crash like this one isn't seen as the end of the world. Far from it. It's seen as a signal, a potential entry point before the next phase of the cycle really gets going.